Today we're chatting with Liesl Malcolm. Liesl is a corporate finance partner here at Pitcher Partners Melbourne. She has over 15 years of experience helping businesses understand what they're really worth. She specialises in valuations for legal matters, restructures and employee share schemes, and is known for breaking down complex issues into clear, practical advice. In this episode, Liesl will take us behind closed doors of business sales and acquisitions, showing what really happens during these critical transactions and how to assess value when considering new opportunities. Let's jump in. Hi Liesl, welcome to the show.
Hi Anna, thanks for having me.
I'm very excited to get into the first question, which is what are the most common misconceptions business owners have about their company's value when they first come to you?
I think the most common misconception is the difference between what the business is worth, what the equity is worth, and what goodwill is. Often business owners get all of those three confused and they don't understand what the difference is between each of them. Goodwill in particular is one where there's a big misconception around. Often business owners think goodwill is something that you add on top of business value. And they also don't necessarily understand the difference between what business goodwill is and what personal goodwill is. So it's about being able to break down that to a business owner, explain them the process, the methodology, how we go about valuing a business, and then being able to articulate to them quite simply the differences between each of those three items. Often business owners are not surprised by the business value that we might come up with. They don't necessarily understand the methodology in getting there, but they're smart people. They know roughly what their business is worth.
And so understanding that methodology, though, can probably be important when there are people that are not so clear on what the value of the business is.
Absolutely. And we would explain with those business owners the types of business valuation methodologies that you would go about in valuing a business, and then being able to explain to them which one is the most appropriate for their business and why that's the case.
And so then what are the factors that influence a company's financial performance and therefore its market value?
One of the biggest things is the historical and the current performance of the business, the risks that are inherent in the business as well, the trends in terms of earnings, margins, their reliance on any customers, suppliers, and the diversification of those risks. Obviously, from a common sense perspective, if you've got a business that essentially has the one customer, there's a risk there that if they lose that customer, the business value clearly diminishes. Also, in terms of the number of competitors that might operate in their space, any industry factors and changes that might be coming in that they're aware of or may not even be aware of are coming in might impact the value of the business, and also what the growth opportunities are and what life cycle stage that business is in is really important.
And is selling a business something that people often make really quickly, or is it something that it's good for you to be involved for a while so that you can get a business into the right position to be at the best it can be?
Look, in an ideal world, you have time. You have time a couple of years before they're thinking about selling that business and transitioning into a new space by enabling them to prepare accounts in a way that are nice and clean, that don't include any sort of personal expenditure that often private businesses have, making sure that they think about diversification of customers. They might think about introduction of different markets that they haven't thought about, all to sort of, de-risk the business that they're in. That gives them the best chance and opportunity to achieve the highest value and price for their business.
So that was probably a bit of a loaded question, but for the listeners who are thinking about starting this journey, how long should they really anticipate having before they're probably in that good position to sell?
I would say, ideally 12 months would be a good time frame to start thinking about that, get things moving.
And so if you're thinking about getting the business valued, what are some of the key things you need to do first? I mean, you've just gone through some of the things that are good to have your ducks lined up with, but is there anything else that you should be thinking about even, years in advance?
Yeah, so making sure that all your accounts are prepared and all tax returns are lodged, that everything is good to go from a financial reporting perspective is really important. Another thing be worth thinking about is doing a business plan and having in that business plan some strategy goals that targets in the next sort of 12 months, 24 months, even further than that if you can. Thinking about preparing some forecasts or some budgets that at least help guide yourself and a potential purchaser where the future may lie would be also important. Thinking about doing something like a SWOT analysis, understanding the strengths, weaknesses, opportunities and threats of the business is a really good place to start. So you actually stand back and think about, okay, what makes this business tick? What are the areas that I should be concentrating on? What are the areas that I need to be aware of and making sure that I'm getting ahead of? And what would someone else who's interested in my business be thinking about?
Yeah, and then what are the weaknesses that they might be targeting to potentially, I'm assuming, try and bring a business price down?
Absolutely. The things that keep you awake at night are typically the weaknesses, and they're sometimes more easily identified than the strengths.
You just talked about the life cycle of the business. And so are there different things and impacts in those different stages? And what might they be? A newer business growing versus a much more mature business? Are there different things you're looking out for?
So in terms of a growing business, the type of valuation methodology that you would use for that might be different from a mature business. Because you've got those growth prospects, you need to incorporate those in undertaking the valuation. And often those growing businesses might achieve a higher multiple than a business that is in that mature phase where there's not that growth, right? You're at maturity, the business is pretty stable. Unless you do something really drastic, you're not going to generate high levels of growth year on year. You're just going to be stable, sort of steady as she goes. Whereas for a business in that growing life cycle, you can incorporate that additional growth, and you might find a purchaser might pay a higher multiple for the fact that they'll be able to achieve that as they go along.
And so for businesses that are scaling up, that sounds like a huge advantage.
It's a huge advantage, correct. Yeah. But whether or not, there's a couple of things there too. It's about whether or not the potential purchaser will pay for the benefit that they might derive in being able to push that business along to achieve their growth potential versus how much will be from the existing owners.
And so obviously there's different approaches depending on whether you're wearing the seller's hat or the buyer's hat.
Absolutely.
And so having that buyer's hat on, what are the top 3 things that you assess when you're valuing the business but from the buyer's perspective?
So the first thing that I would always consider is the risk. What's the risk of this business that you're buying, both from an operational and a financial perspective? So really going through and understanding the financials, understanding what's driving revenue, what's driving margins, what's driving expense increases or decreases is really important. You really need to get a handle on those things to make sure that the business that you're buying and the earnings that you're buying are appropriate, they're stated correctly, and that you've got confidence in the numbers that are being reported by the existing management.
I would assume that listeners are really interested in understanding the impact of AI on business purchases. And so what are you seeing as some of the risks of AI-generated business valuation software when it's establishing the overall value of a business?
So the biggest risk for that using AI software is really around the fact that it's not transparent. Other than, you know what inputs you're putting in, you've got no way of knowing how those numbers are calculated. There's also no analysis that's been undertaken in terms of those financials that are being used or whatever input data. It's literally sort of a formula that's spitting out a number, and you can't verify, audit, go through, talk to management about the numbers, how that valuation is being driven. You've just got no understanding. And I know certainly from any kind of litigation or tax purposes, you're not allowed to use any AI software because of that fact. There's no substance behind the outputs that's being spit out.
Are you seeing AI come into this space at all?
Thankfully, not so much as yet, which is great. I think we're certainly seeing it from businesses or other valuers using it to help them determine appropriate transactions and comparable multiples. But thankfully, to this point, those other valuers are still going through the process of making sure that they understand the data that is being spit out by those AI software programs.
And given the risks then for a seller probably in using AI to generate a business valuation, is it possibly something more that buyers are using to analyse valuations, or that's not something you've seen?
I think buyers in particular are more cautious and they're probably less likely to use AI software. Sellers might use it to give themselves an overall guide of what they think they could sell the business for, which obviously is fraught with danger, because if you're using an AI software tool and it spits out a really high number, there's a real big risk there. You're going to get sticker shock, right, in terms of what this software is telling you it's worth, and then you go out to the market and buyers are coming back at, maybe half the value that you anticipate, and you have to reset your expectations there. But I would probably say that more sellers are using it than buyers.
And I think that given the risks we're seeing, certainly in court and other places where people are relying on this without the human oversight, clearly business valuations needs a human touch.
Absolutely. It's a very specific, bespoke financial service that we provide. You really need to understand and spend time with management, the business that you're valuing, to understand the operations in detail, to understand the drivers behind all those financials, to enable you to properly ascertain what the business is worth.
It's not always 1 + 1 = 2.
No. If only it was that easy.
And so how are the new regulatory and compliance costs impacting on the value of businesses?
So I think any increases or changes to regulation and compliance costs obviously impacts evaluation, and typically that would be a downwards impact. I think one of the other key things around regulation and compliance costs that is often missed, especially in terms of private businesses, is we've seen the last couple of years this emergence of using employee incentive programs such as options and rights to incentivise their staff instead of paying bonuses, increasing salaries, whatever the case may be. And while these types of incentives are really great for the larger, growing private businesses, when they're issued for smaller private businesses, often the compliance costs of implementing those programs actually outweighs the benefit. I think small businesses don't understand that in order to properly account for these type of instruments, at the outset they need to undertake evaluation to understand what the equity value or the share value is. Then they probably have to do that on an annual basis to update every time they grant and issue any new of these options and rights. And then what they need to do is also undertake a valuation of each of those rights at each point in time to understand what the accounting and the tax implications are. So I think that often, while in theory these things are a great idea, sometimes in practice, depending on the size of the business, there are additional costs for these businesses that don't really need to be incurred.
And sounds like something that then for a buyer would make a lot of angst around what does this do and how am I going to continue it potentially?
It just makes it more complicated than it needs to be. Yeah.
And so then we hear a lot about technology, but how does investment in technology affect a company's valuation?
So there's a couple of things. So any investment, like any kind of capital expenditure, from a valuation purpose, we would treat as an abnormal or a one-off item, because often businesses are not incurring those costs every year. So from a pure, valuation standpoint, we would exclude any of those IT investment costs. However, there's another benefit that by investing in that type of infrastructure would be really beneficial for the business. So if by undertaking that investment, that means that the business achieves cost savings elsewhere and can achieve a better margin, perhaps they frees them up from doing certain menial tasks that enable them to help grow different areas of the business or focus their energy into other areas, that ultimately would improve the value over time. But on the flip side of that, you just need to make sure that that investment actually does realise in those cost savings, and that everyone in terms of the staff, management are on board with that investment, and you actually be able to achieve those cost savings. And sometimes doing a financial model at the start is really important to understand, well, if we do make this big IT spend, what do we think the impact will be from a forecast perspective? What cost savings do we think we're going to be able to achieve, and try and track those? And
so then in the business valuation, you would really articulate what those are and what they were likely to continue to be.
Absolutely. And then obviously that means if you've got cost savings, you've got a higher profitability and earnings, and that translates to a high value.
Comes back to you can't just have 1 + 1 = 2. You have to have an explanation and an understanding of why things are in place. It's not just numbers on a page.
Absolutely, which I think, to the point that we were discussing earlier around AI, you wouldn't understand that. The software program wouldn't be able to be that intuitive to understand what is driving those changes and are those changes likely to be continued.
And so can you share a real case of a particularly challenging valuation or transaction that you have worked on?
I think in terms of the challenging valuations, they're always around where you have a very big difference between a business owner, their expectation of value, and what the actual value of the business is. And that might come about in terms of their misunderstanding of what multiples are being paid for in that particular industry. Often they will know a friend of a friend that achieved, a 10 times multiple for their business without actually understanding, was that 10 times profit? Was that 10 times EBITDA? What was it? And they've really got no understanding of that. They also may not understand in terms of adjustments that need to be made in terms of, is rent being paid at market? Owners' salaries at market, and we might need to make a whole heap of adjustments in those scenarios. And I think we're really lucky here at Pitcher Partners in that the valuations team sort of sits in as part of the broader corporate finance team. So what that means is that any report and therefore multiple that I might think is appropriate, we discuss as a team in terms of, well, from an M&A and a DD perspective, so from an actual real-life transaction, buying and selling businesses, is that multiple supportable? Could you actually achieve that in the market? And do we have, our own internal sort of proprietary information that would further support that, yes, we would be likely to achieve that? And I think the biggest thing is then communicating with that business owner where the variances lie, why there is such a difference between their expectations and reality, and then about what they can do to bridge that gap. And I guess that to your point, Anna, that, we talked about earlier around how early in the piece should you start those conversations. When you've got that scenario, the earlier that you can start those, the better. So if you've got, instead of a 12-month runway, if you've got 3 years for them to improve that business over time, that's really great when you've got such a divergence in expectation and reality.
And I was just thinking that listeners are probably remembering those first things that you said and thinking the longer lead in you have, the less of a shock it will be, but also the more opportunity you have to set things right in the right direction to make sure that it isn't actually that challenging. It might look like that at the start, but starting with the right people helping you will probably make it far easier.
Absolutely.
Is there anything else that you think listeners need to understand or know about this process or business valuations in general?
I think just if you've got any questions, always happy to take a call to go through what valuation methodologies there are, any random questions around, well, how would you go about this? What kind of multiples are you seeing in the industry? How can we improve the profitability and the revenue of my business? What sort of things do you take into consideration? I think all those initial chats are really beneficial and helpful for a lot of business owners, and we're always happy to do that.
And again, starting as early as possible, I think, is the key.
Yes.
So thank you so much, Liesl. It's been a pleasure to speak to you today.